If you think $500 is too small to matter, you've already lost. The market doesn't care about your rent money or your dreams of quick riches. It only respects one thing: discipline. And that $500 is about to show you exactly how much you have. Here's the brutal truth most traders spend years avoiding. If you can't protect $500, you'll never protect $50,000. The dollar amount isn't the test. Your behavior is. The way you treat $500 is exactly how you'll treat $5,000, $50,000, and $500,000. Only the zeros change. You don't suddenly become disciplined when you get more capital. You scale your current habits. And that's either terrifying or empowering, depending on who you are right now. The market is a mirror that reflects back your deepest psychological flaws, magnified and monetized. Every impulse you suppress in normal life becomes amplified when money is on the line. Every shortcut you take, every rule you bend, every moment of impatience, the market sees it all and charges you tuition for the lesson. Picture two traders starting the same challenge today. Same broker, same market, same $500. But completely different destinies. Trader A sees $500 as a lottery ticket. In his mind, he's already spending the future profits. He's calculating how fast he can flip this into serious money. He risks $50 to $100 per trade, no real stops, just mental levels that shift whenever the pain gets too intense. He needs excitement. He needs action. He refreshes his portfolio every 30 seconds, feeling alive when positions move, dead when they don't. To him, trading is entertainment with a scoreboard. He tells himself he's aggressive, but he's just reckless. He confuses activity with progress, motion with direction. Trader B looks at the exact same $500 and treats it like it's his last $500 on earth. He's not daydreaming about doubling it in a week. He's thinking, my only job is to still be here 90 days from now. He risks $5 to $10 per trade. He uses hard stops placed at logical chart levels. He can walk away from his screen for hours because his rules do the thinking. Boring execution. Repetitive process. He needs results, not entertainment. To him, trading is a business with overhead and risk, not a show. In 2 weeks, Trader A either doubles his money or blows up. Usually blows up. When he wins, he feels like a genius and increases his size. When he loses, he feels cheated by the market makers, the algorithms, anything except his own lack of discipline. His emotions swing as wildly as his equity curve. Trader B, 2 weeks in, might be up 3%, might be flat, might even be down slightly if the setups haven't materialized. But he's calm. He's collecting data, not trophies. He's building a foundation that will support weight later. Trader A feels like a trader. Trader B is becoming one. This is the identity divide that will define your $500 challenge. Are you playing, or are you building? Are you chasing sensation, or are you building a track record? Your $500 account is a mirror. It reflects your real relationship with risk, patience, and greed. It exposes how you handle frustration, boredom, and the urge to just do something. It shows whether you're an amateur chasing dopamine hits or a professional building an empire one disciplined trade at a time. You can tell yourself any story you want, but your executions don't lie. Your fills, your stops, your size, that's your real personality on paper. Most people never look in this mirror honestly. They blame external factors. The market was manipulated. The stock was too volatile. The news was unexpected. But the mirror doesn't lie. If you're overtrading, it's because you're bored. If you're oversizing, it's because you're greedy. If you're moving stops, it's because you're afraid of being wrong. The account balance is just the scoreboard. Your behavior is the game. Jesse Livermore lost millions multiple times, but he understood something most never learn. The game taught me the game. Notice what he didn't say. He didn't say books taught him the game. He didn't say predictions or gurus taught him the game. He learned by paying tuition to the market. Before you can handle size, you must handle yourself. And you can only handle yourself when the stakes are real enough to sting, but small enough that ego can't sabotage the lesson. That's the genius of the $500 challenge. It's real money. Losing $50 actually hurts. But it's not life-destroying. You won't be evicted if you blow it. You won't lose your marriage. You can absorb the lessons without absorbing catastrophic damage. This is the sweet spot for learning, painful enough to matter, small enough to survive. The amateur looks at $500 and sees limitation. The professional looks at $500 and sees liberation. With only $500, you can't afford to be stupid. You can't afford to revenge trade. You can't afford to hold losers and hope. You can't afford to trade without a plan. The small account forces discipline in a way large accounts never do. When someone starts with $50,000, they can lose $5,000 and still feel like they're in the game. They learn nothing except how to slowly bleed. But with $500, 3 bad trades and you're crippled. 5 bad trades and you're done. The feedback is immediate. The consequences are clear. The lessons stick. This challenge isn't about turning $500 into $50,000 in 6 months. That's Instagram fantasy designed to sell you courses. If that's why you're here, you're going to get slaughtered. This is about using $500 as tuition for the most expensive education on earth, learning to control the most dangerous variable in trading, which is yourself. Not the market, not the algorithms, not the institutions. You. Your fear when you're losing. Your greed when you're winning. Your impatience when nothing is happening. Your ego when you're proven wrong. Every professional trader you've ever heard of went through some version of this crucible. They all paid tuition to the market. The only question is how much tuition you'll pay and what you'll learn from it. Some traders pay $50,000 in tuition and learn nothing because they never accepted responsibility. Other traders pay $500 in tuition and learn everything because they treated every loss as data, every mistake as a lesson, every moment of discipline as a deposit in their psychological account. Think about the pilot of a commercial airliner. Before they ever touch a real plane with real passengers, they spend hundreds of hours in a simulator. They face engine failures, storms, and emergencies in a controlled environment. If they crash the simulator, nobody dies. Your $500 account is your simulator. But it's a simulator with live ammunition. It stings just enough to be real, but not enough to ruin your life. If you cannot follow your rules when the risk is $10, do not lie to yourself and say you will follow them when the risk is $10,000. You won't. Fear scales. Greed scales. If you panic over a $20 loss today, you will have a breakdown over a $20,000 loss tomorrow. The behavior is identical, only the damage changes. So here's the contract for this challenge. For the next 90 days, you're going to divorce yourself from the outcome of the money. You're going to fall in love with the process. You're going to stop asking how much can I make and start asking, did I execute correctly? If you follow your plan, take your stop loss, and lose $10, that's a successful trade. You paid for information and protected your capital. If you break your rules, move your stop, and make $100 because you got lucky, that's a failed trade. You just taught your brain that discipline doesn't matter. Over the next chapters, we'll build your fortress of discipline brick by brick. We'll cover the mathematics that keep professionals alive while amateurs blow up. We'll explore the psychology of waiting that amateurs never master, the ability to sit in cash while opportunity develops. We'll break down the pyramiding techniques that turn small edges into substantial profits, the art of adding to winners instead of averaging into losers. But first, you need to understand the one rule that separates the living from the dead: position sizing. Because it doesn't matter how good your entries are, how perfect your chart reading is, how sophisticated your indicators are. If you size your positions wrong, nothing else matters. You can be right on direction and still blow up your account. Trade your $500 as if it's your last $500 on earth, because one day it will be. One day you'll face a moment where everything depends on whether you followed your rules or broke them, whether you protected your capital or gambled it away, whether you built discipline in the small moments so it was there in the big moments. That's what this challenge is really about, not the money. The mirror. Amateurs ask, how much can I make on this trade? Professionals ask, how much can I lose and still be trading tomorrow? This single shift in questioning represents the line between survival and extinction in trading. It explains why 90% of small accounts vanish within 6 months. They don't die because the market is rigged or because luck runs out. They die because the trader never understood the mathematics of survival. The math that destroys amateur traders is both simple and brutal. It's called the asymmetry of loss, and it will kill your $500 account faster than any market crash or news event ever could. Here's how it works. Lose 50% of your $500, and you're left with $250. Your emotional brain tells you, I just need a 50% gain to get back to even. But mathematics doesn't care about your emotions. On that remaining $250, a 50% gain only gets you to $375. To return to your starting point of $500, you need a 100% gain. You have to double your money just to break even. The formula for recovery is unforgiving. Recovery required X, 1 loss percentage. 1 for a 50% loss. 10 50. 112201 100% for a 75% loss. 10.75. 1 1/4 0.25. 1 1 lows 300%. The deeper the hole, the steeper the climb. Lose 75% of your account, and you need a 300% gain just to see daylight again. At that point, you're not trading anymore. You're praying. And prayer is not a trading strategy. This asymmetry is why position sizing isn't just important, it's the only thing that matters before anything else can matter. You can have perfect chart reading skills, flawless timing, and decades of experience. But if you size wrong, you die. Not metaphorically. Your account dies. And with it, your ability to participate in the one game that rewards skill over time. In the $500 challenge, your survival rule is non-negotiable. You risk exactly 1-2% of your account per trade. On $500, that's $5 $10 per trade. Does that sound pathetically small? Does your ego scream that you can't get rich risking $5? Perfect. That reaction is your amateur identity talking, and your amateur identity is not your friend in this business. If you cannot respect a $10 risk, you will never respect a $10,000 risk. The number of zeros doesn't magically grant you discipline. It only amplifies your current lack of it. Right now, with your small account, you're programming your brain's operating system. Every trade writes code about how you handle risk, fear, and greed. Teach yourself that rules are flexible when stakes are small, and you won't suddenly develop discipline when stakes are large. Here's the protocol that separates the living from the dead. You calculate your stop loss based on chart structure first, never on how much you want to risk. You identify the level where your trade idea is proven wrong, below a support level, beyond a pivot point, or past a key moving average. That price level is your logical stop, not where it feels comfortable, not where it fits your desired risk, where the chart says you're wrong. Only after you've identified that level do you work backward to determine position size. You measure the distance between your entry price and your logical stop. If that distance is 50 cents per share and your maximum risk is $10, you can buy exactly 20 shares. If the logical stop creates a $15 or $20 risk for your usual share size, you have two choices: reduce your position size or skip the trade entirely. What you cannot do, what will kill you, is move the stop closer just to fit more shares into your position. Let me show you exactly how this plays out with two traders taking the same trade. Both are watching a stock breaking out above $20. The logical stop, based on chart structure, is 19.50 cents. That's a 50-cent risk per share. Trader C follows the $500 challenge rules. He wants to risk $10 maximum. With a 50-cent stop, he calculates 20 shares as his position size. He enters 20 shares at $20 with a hard stop at 19.50. His maximum loss is exactly $10. Trader D looks at the same setup and thinks, I can't make real money on 20 shares. I need size to make this worthwhile. He enters 100 shares at $20, risking $50 if his stop hits. He tells himself he can handle the larger risk. The market immediately tests their resolve. Algorithms hunt for stops. The price whips down to 19 with a 45 cents, piercing the logical stop level by 5 cents. Trader C's hard stop triggers automatically. He's out with a $10 loss. He's annoyed, but psychologically intact. His account barely registered the hit. He closes the chart and begins scanning for the next setup with a clear mind. Trader D watches his position plummet to 19.45 cents. He's now down $55 on paper. His logical stop should have triggered at 19.50 cents, but he used a mental stop because he wanted flexibility. Now his brain floods with stress hormones. His vision narrows, his rational mind goes offline. He thinks, this is just a shakeout. Market makers are hunting stops. I can't take a $55 loss on a $500 account. That's more than 10% of my capital gone in one trade. So he makes the fatal decision. He moves his mental stop to $19.30 to give the position breathing room. The stock drops to $19.40. Now he should exit based on his new stop, but he's already moved it once, and he's down $60. His brain rationalizes. Just a little more. It has to bounce here. The stock finally bottoms at 19.35 cents, then rockets back above $20 and runs to $22. Trader C, who took his clean $10 loss, sees the stock reclaim $20 with strong volume. He re-enters at $20.20 with his disciplined 20-share position and rides it to $21.50 for a $26 profit. Net result, down $10 on the first trade, up $26 on the second, net positive $16. More importantly, his discipline is reinforced. He learned that respecting stops keeps you in the game. Trader D finally panic sells at 19.40 cents for a $60 loss, then watches the stock run to $22 without him. Rage builds. He feels cheated, stupid, left behind. So he chases the stock at $21.20 with 80 shares, desperate to make back his loss. The stock peaks at $22.10, and he sells at $21 for a $48 profit. He feels vindicated. He made back his loss and then some. But here's what actually happened. Trader D violated every rule. He oversized, moved his stop, panic sold at the worst moment, then revenge traded by chasing. He got lucky on the chase and learned the worst possible lesson, that breaking rules can work. His brain just got programmed to believe discipline is optional. He's now a ticking time bomb. Same chart, same opportunity, completely different psychology and outcomes. The difference was position sizing. Small, consistent risk creates psychological armor. It eliminates the urge to move stops because a $10 loss doesn't trigger your fight or flight response. It eliminates the urge to double down because you're not trying to dig out of a catastrophic hole. It eliminates revenge trading because there's nothing to revenge. When losing $7 feels like paying for market data, just a cost of doing business, you can follow your plan. When losing $70 feels catastrophic, you become your plan's biggest enemy. Your position size is your real stop loss. The number you enter in your trading platform is just backup. If you size too large, it doesn't matter where you place the stop. Your emotions will override it. You'll move it, cancel it, or ignore it when fear floods your system. Size wrong, and nothing else matters. Not your technical analysis, not your experience, not your years of study. Too big, and you're dead. Consider the mathematics of survival across multiple trades. Risk 2% per trade on your $500 account. That's $10 per trade. You could be wrong 10 consecutive times and only be down about 18% after compounding effects. That's painful, but survivable. 10 losers in a row is rare if you're following a tested process, and you still have room for the inevitable randomness that markets deliver. Now consider risking 10% per trade, $50 each time. Just 5 consecutive losses, which can absolutely happen to any trader, drops your $500 to roughly $295. You're down 41%. To recover from there requires approximately a 70% gain. The mathematics of recovery have shifted dramatically against you, and you haven't even experienced a particularly unusual losing streak. This is why professionals think in series, not single trades. They see every position as one of the next 100 trades. They ask, can I survive the inevitable losing streak that's coming? Amateurs treat each trade like a lottery ticket, going all in emotionally and financially, as if this one decision will change their life. There's another critical benefit to fixed, small risk that few traders recognize. It creates clean data. When every trade risks roughly the same dollar amount, you can review your trading journal and actually determine whether your strategy has an edge. You're comparing apples to apples. If one trade risks $10, another $70, and another $25, your results become meaningless noise. You won't know if your system works or if random position sizing is creating false profits. Over time, this 1-2% rule rewires your relationship with loss. Losses stop feeling like personal failures and transform into expected business expenses. When a loss is just $7, you don't need to defend your ego. You can admit the market proved you wrong, exit cleanly, and move on. That humility becomes a superpower in a game where being wrong is inevitable. But this discipline creates an apparent paradox. If you're only risking $5.10 per trade, how do you ever grow your account meaningfully? How do you turn $500 into substantial capital if you're content making a few dollars per winner? This question exposes exactly where amateurs derail. They hear small risk and think small future. Professionals hear small risk and think big future, if I learn to press my advantage correctly. The path forward isn't abandoning discipline when you see a good trade. It's using discipline to earn the right to scale up when the market proves you're right. You don't gamble bigger from the start. You earn bigger by first proving you can control risk. That's where Jesse Livermore's favorite weapon becomes essential, pyramiding into strength. You start small, survive the noise, and once the tape confirms your thesis, you add to winners using the market's money, not hope. Here's what kills more $500 accounts than bad entries, poor stops, or market crashes combined. Boredom. Not fear. Not greed. The suffocating, excruciating inability to sit still when nothing is happening. The amateur sees empty time as wasted opportunity, as money left on the table, as proof they're not really trading. The professional sees empty time as capital preservation, as the foundation that separates survivors from statistics. This difference in perception determines who joins the 90% failure rate and who builds lasting wealth. Because the dirty secret of professional trading is that most of your time is spent doing absolutely nothing. You're not executing trades. You're not analyzing every tick. You're waiting. And waiting is the hardest skill you'll ever develop, because modern life has programmed you to equate activity with productivity, motion with progress. Jesse Livermore's most famous quote wasn't about catching moves or reading the tape or timing perfect entries. It was about patience. It was never my thinking that made the big money for me. It was always my sitting. Not his analysis, not his predictions. His ability to sit motionless in cash until the market offered him something he couldn't refuse. In a $500 challenge, this wisdom transforms from philosophical observation into survival doctrine. You cannot afford boredom trades. Your capital is too small, and your margin for error too thin. Let's dissect exactly how this plays out. You're 3 weeks into the challenge. You've followed every rule religiously. You've taken 4 trades, 2 winners that netted $14 and $11, 2 clean losses that cost $8 and $9. Your account sits at $518. You're up 3.6%. Nothing spectacular, but you're green and building discipline. You feel like you're constructing something real, something sustainable. Then the market goes into a coma. Day 5 passes without a single setup meeting your criteria. Day 6, nothing. Day 7, still nothing. Your carefully defined requirements, the specific chart patterns, volume signatures, confirmation signals, none of them materialize. The market is choppy, whipsawing, or trending in sectors you don't trade. Your watch list mocks you with its inaction. Now your brain starts doing what brains do when they're chemically dependent on stimulation. It manufactures reasons to trade. This setup is close enough to my criteria. The volume isn't quite there, but the pattern looks right. That's rationalization, wearing the mask of analysis. I need more data points to refine my system. How can I improve if I'm not trading? That's impatience disguised as research. What if I miss the big move? What if this quiet period ends and I'm not positioned? That's fear of missing out, the most expensive emotion in trading. These aren't rational thoughts. They're withdrawal symptoms from your dopamine addiction. Every time you click buy, your brain releases dopamine. Every time you watch a position move in your favor, more dopamine floods your system. Every time you close a winner, your reward circuits light up like a Christmas tree. Your brain doesn't care if you're making money. It craves the neurochemical reward of action. When that stimulation disappears for 6 consecutive days, your brain starts screaming for its fix. The amateur trader surrenders to this neurochemical pressure. He takes the close enough setup, telling himself he's being flexible and adaptive. He's actually just bored and chemically dependent on the feeling of having risk on. That trade usually fails because it didn't meet his criteria for a reason. Now he's down money instead of up, and his discipline has cracked. He's taught his brain that rules are negotiable when discomfort arrives. Here's the mental shift that changes everything. Waiting is a position. When you're holding $500 in cash, you are not inactive. You are not sitting on the sidelines watching life pass by. You are positioned in the most flexible, most powerful stance possible. You're fully loaded with ammunition, exposed to zero risk, ready to strike when the tape shows clear direction. You're like a sniper lying motionless in tall grass, not a machine gunner spraying bullets hoping something hits. Cash is a position. Repeat this until it rewrites your operating system. You're not missing opportunities by holding cash. You're creating the capacity to seize the right opportunity when it materializes. Every mediocre trade you skip preserves capital for the excellent trade that's coming. Every day you maintain discipline, you're making a deposit in your psychological account that compounds over time. Most amateurs have never considered that cash represents active choice. They think they're only in the market when they have a trade on, so they measure worth by activity level. They need to feel engaged, involved, like real traders. Professionals understand you're always in the market, either risking capital or protecting it. Both are deliberate decisions with consequences. The protocol for mastering this art is ruthless in its simplicity but agonizing in execution. Before you risk a single dollar, you write down your exact setup criteria with painful specificity. Not vague guidelines that bend under pressure. Exact specifications that leave no room for interpretation. What chart pattern qualifies? Bull flag, cup and handle, breakout above resistance with successful retest. What volume signature must be present? Volume 50% above average, twice average, 3 times average on the breakout candle. What confirmation do you require? Price holding above breakout level for 15 minutes, 30 minutes, an hour. What time constraints apply? Only first 2 hours when volatility peaks? No lunch hour trades when volume dies? What market conditions must exist? Overall market and confirmed uptrend. Sector rotation favoring your stocks? Volatility within specific ranges? You document every requirement because vague criteria become flexible criteria, and flexible criteria become worthless criteria. I'll know it when I see it isn't a system, it's emotional trading wearing a professional costume. During the challenge, you trade only when all criteria align simultaneously. Not most of them. Not the important ones. Every single requirement must be satisfied. This filter protects you from your worst enemy, yourself. When boredom strikes, when your fingers itch over the buy button, when your brain manufactures urgent reasons to act, you consult your written criteria and ask one question. Does this setup meet every requirement I defined? If the answer isn't an immediate, obvious yes, you close the chart and walk away. Here's the counterintuitive truth that will save your account. In 90 days, you might only discover 15 to 25 truly high-quality setups meeting all criteria. Some weeks deliver 3 opportunities. Other weeks offer 0. That's not failure or missed profits. That's professional selectivity. That's what trading with a genuine edge looks like instead of gambling for entertainment. The amateur takes 60 trades in 90 days. He's active, engaged, constantly in action. He feels like a real trader. He tells friends he's day trading. But he learns nothing except how to lose consistently, because most of those 60 trades were mediocre setups taken to feed his need for stimulation. His results are random noise masquerading as skill. The professional takes 20 high-quality trades in 90 days. To outside observers, he appears lazy, uninvolved, barely participating. But he's constructing a fortress of disciplined execution. Every one of those 20 trades met his criteria precisely. Every one taught him something about his system's effectiveness. Even the losses were high-quality losses, trades where setup was correct but market didn't cooperate. His results aren't noise. They're data revealing whether his edge exists. This is compound discipline in action, more powerful than compound interest. Every single day you don't take a mediocre trade, is a day you don't set yourself back. Your emotional capital stays intact. Your confidence in your process grows stronger. Your ability to trust systematic thinking over impulse develops. You're filtering signal from noise while amateurs donate accounts to market makers and algorithms designed to exploit impatience. Consider what happens neurologically when you skip a mediocre setup. Initially, it stings. You watch a stock move without you, and loss aversion screams that you're missing out. But 6 hours later, when that stock whipsaws and traps impulsive traders, you feel vindicated. You feel intelligent. You feel disciplined. That positive reinforcement is a deposit in your psychological account. Execute this pattern 50 times in 90 days, and you've built unshakable self-trust. Now consider the opposite scenario. You take a mediocre trade to feel involved, to scratch the itch of boredom. Initially, it provides relief. You're participating. You're a real trader. But when it loses, as mediocre setups typically do, you feel foolish and undisciplined. That's a withdrawal from your psychological account. Do this 50 times, and you're trading on emotional tilt, desperately trying to recover losses, spiraling into the death pattern that destroys accounts. Let me show you exactly how this plays out with two traders facing identical circumstances. Trader E and Trader F both start the $500 challenge with the same criteria: breakouts above prior resistance, with heavy volume during first 2 hours, while the overall market trends favorably. For 2 weeks, this pattern appears only twice. Trader E takes both trades following his risk rules precisely. One wins $12, one loses $8. He's basically flat but psychologically intact. Then 8 consecutive trading days pass without qualifying setups. Price action turns choppy, volume inconsistent, market direction unclear. Trader E maintains discipline. He watches, studies, screenshots potential setups that don't quite qualify, journals his observations. After 8 days, his account remains around $502. Boring, unimpressive to amateur eyes, but perfectly intact and ready for action. Trader F endures 3 quiet days before cracking. I need more repetition, he tells himself. I can't improve sitting here doing nothing. I need screen time. So he starts bending rules. Sloppy breakout? Good enough. Volume slightly below threshold? It'll probably surge after I enter. Market chopping sideways? This stock moves independently. He takes 5 trades over the next week. 3 small losers, 2 tiny winners. After commissions and slippage, he's at $462. He's stressed, frustrated, questioning his entire approach. While Trader F burned emotional and financial capital on low-probability trades, Trader E preserved his ammunition. When clean breakouts finally reappear, Trader E is mentally fresh and financially ready. Trader F is psychologically damaged, trigger-shy, and desperate to recover losses. Same market, identical opportunities, completely different outcomes based solely on their relationship with boredom. You're not paid per click. You're not paid per trade. You're not paid for activity, screen time, or appearing busy. You're paid per correct decision. Sometimes the most profitable decision is doing absolutely nothing, sitting in cash, preserving discipline, waiting for the market to offer something you can't refuse. Professional traders understand what amateurs never grasp. Markets don't owe you entertainment. They don't exist to provide constant action. Markets are arenas where patient capital systematically extracts money from impatient capital. Every time you trade from boredom, you volunteer for the losing side of that equation. Think of yourself as a predator, not prey. Lions don't chase every antelope they see. They lie motionless in tall grass for hours, sometimes days, waiting for the perfect moment when success probability peaks. When that moment arrives, they explode into action with devastating precision. Amateur traders are like hungry house cats, constantly pouncing at shadows, expending energy on low-probability targets, never building the patience required for meaningful success. Every morning, look at your $500 and remind yourself, your goal isn't making money today. Your goal is executing your plan flawlessly. If your plan says no trades, and you don't trade, you achieved perfection. You defeated the urge to gamble. That victory compounds more powerfully than any lucky profit. But here's the critical transition that completes this lesson. Waiting means nothing if you can't execute when opportunity finally materializes. All the patience in the world becomes worthless if you freeze when your setup appears, second-guess your entry, or hesitate and miss the move. Discipline isn't just about doing nothing. It's about doing nothing until it's time to do everything with complete conviction. And when that moment arrives, when your criteria align and the tape screams for action, you need to know exactly when to cut your losses fast. Because the same discipline that keeps you patient in cash must keep you ruthless in execution. That's where survival and growth intersect, where waiting transforms into winning. Your stop loss isn't a suggestion. It isn't a guideline you can negotiate with when the market moves against you. It is a blood oath contract you sign with yourself in the calm moments before you enter the battlefield of live trading. It is written when your pulse is steady, your logic is clear, and your emotions are under control. Break that contract once, just once, and you've taught your brain the most dangerous lesson in trading, that your rules are optional when discomfort arrives. That's how traders die. Not from one catastrophic black swan event, but from the slow, methodical erosion of discipline, one compromised rule at a time, until there's nothing left but wreckage and bitter lessons learned too late. Most traders think they blow up because of some wild, unpredictable market move, some unexpected news event, or algorithmic flash crash. But if you rewind the tape on almost any blown account, you won't see a single disaster. You'll see a pattern of small compromises. A stop moved just this once. A loser held a little longer. A rule bent because this setup looks different. Erosion, not explosion, kills most traders. They teach themselves, trade by trade, that survival rules don't really apply when they're uncomfortable. Here's the exact scene that plays out in 90% of blown accounts. You can script it frame by frame, because it's that predictable. You enter a trade following your $500 challenge rules perfectly. You buy at $20, targeting $22, with a stop loss at $19.50. You're risking exactly $10 on 20 shares. The setup looked clean, volume confirmed. You followed your system precisely. But then the price starts drifting against you. It hits $19.80, then $19.70, now $19.60. You're down $8 on paper, and your stop sits just 10 cents away at $19.50. This is the moment of truth. This is where amateur and professional traders diverge forever. Your brain, sensing danger and flooded with stress hormones, starts offering deals. Look at that support level at $19.40. It's so obvious. If I just wait a little longer, it might bounce there. The overall market is still strong. This is probably just a quick shakeout before the real move. If I sell now, I take the loss for sure. If I hold, there's still a chance I can get out at break even. These thoughts feel rational. They feel like analysis. They're neither. They're your emotional brain hijacking your decision-making process to avoid the sharp, immediate pain of admitting you were wrong. Your ego cannot tolerate the idea that you made a mistake, so it manufactures reasons to hold, to hope, to wait for salvation that rarely arrives. You hesitate. You cancel your hard stop just for a second to see what happens. The price drops to $19.50. Your original exit level is hit, but you're no longer protected by automation. It ticks to $19.48. Now you're down $10.40. Your risk limit is exceeded, but you've already violated your plan, so what's another few cents? The price slides to $19.30. You're down $14. Your brain rationalizes, it has to bounce here. Everyone can see this level. But it doesn't bounce. It drops to $19.10. Now you're down $18. Your logical stop at 19.50 cents is a distant memory. You're no longer trading your setup. You're no longer following any system. You're trading hope, prayer, and denial. You've transitioned from systematic trader to desperate gambler, and you don't even realize when it happened. Finally, the pain becomes unbearable. You can't watch anymore. Your heart is pounding. Your vision is narrowed. Your rational mind has gone completely offline. You panic sell at $19.05, taking a $19 loss instead of the planned $10 loss. The stock, freed from your desperate energy, immediately bounces to 19.60 cents, then rallies back above $20 cents. You just donated an extra $9 to the market, and receive nothing in return except confirmation that you cannot trust yourself under pressure. The amateur moves stops to avoid the psychological pain of being wrong. He treats the stop-loss as an insult to his intelligence, a suggestion that he might have made an error. The professional takes the loss the moment the stop is hit, because he understands something the amateur doesn't. The stop-loss isn't about this specific trade. It's about the next 100 trades. It's about maintaining the psychological infrastructure that allows him to execute his system without interference from emotion. Think about what you're really doing when you honor a stop. You're not just closing a position. You're voting for the identity you want, professional or amateur. Every time you take a clean loss, exiting exactly where you said you would, you're making a deposit into your psychological bank account. You're building self-trust. You're proving that your word to yourself means something. You're training your brain that discipline produces better outcomes than hope. Every time you move a stop or hold past it, you're making a withdrawal from that psychological account. You're teaching yourself that rules are flexible when discomfort arrives, that your plans don't really matter when fear floods your system. Make enough withdrawals, and you bankrupt yourself psychologically long before you blow up financially. With a $500 account, the mathematics are brutally unforgiving. Just 3 trades where you let $10 losses become $30 losses, and you're finished. Not just financially, psychologically. 3 violations of $20 each, and you've lost $60, or 12% of your capital. But the psychological damage exceeds the financial damage. You've proven to yourself 3 times that you cannot be trusted when pressure arrives. How do you enter the 4th trade with any confidence? You can't. You're trading scared, second-guessing every decision, frozen by self-doubt that you created through your own rule violations. Here's the protocol that separates the living from the dead. First, you determine your stop-loss before you enter the trade, based on chart structure where your thesis is proven wrong, below support, beyond a pivot, past a key moving average. Second, you write that number down physically. There's something powerful about dragging pen across paper that anchors the commitment in reality. Third, and most critically, you place a hard stop in your trading platform immediately after entry. Do not use mental stops. Mental stops are lies you tell yourself. They are myths about your ability to execute under pressure. When red candles are printing and fear floods your system, when your heart rate spikes and your vision narrows, when stress hormones shut down your prefrontal cortex, your rational mind goes offline. You become a frightened animal looking for escape. The only thing standing between you and catastrophe is that pre-programmed exit order sitting on the exchange server, executing automatically when price touches your level. Jesse Livermore learned this through brutal experience. The only thing to do when a man is wrong is to be right by ceasing to be wrong. Translation: don't negotiate with wrong. Don't manage it. Don't hope it improves. Cease it immediately. Cut fast. The market will give you 1,000 chances to re-enter if your thesis is correct, but it will never give you back the capital you donate by hoping against the tape. A small loss is a gift. It's feedback from the market, information about your setup, tuition paid for real-time education. It preserves 98% of your risk capital for the next opportunity. A large loss created by moving stops is a lesson you'll pay for forever, not just financially, but psychologically. It destroys confidence, breeds hesitation, and creates scars that influence your trading for months. You must become a surgeon with your losing trades. A surgeon doesn't hesitate to remove diseased tissue to save the patient. They don't bargain with infection or hope it goes away. They cut cleanly, coldly, professionally. The moment your trade tissue is dead, the moment price hits your stop, you remove it without emotion. You don't feel sad or angry. You feel proud that you executed your job with precision. This defensive discipline is your foundation. Without it, no strategy works. You can be the greatest chart reader in the world, but if you cannot take a small loss, you will eventually find the one trade that removes you from the game permanently. But defense alone won't grow your account. Once you master the art of losing small, you're ready to learn the most powerful wealth-building secret: how to press your advantage when the market proves you right. Most traders use their $500 backward. They operate with an inverted logic that guarantees failure. They cut their flowers and water their weeds. They're terrified of losing small profits, so they grab them the moment they see green, then watch helplessly as stocks continue climbing without them. Yet they're strangely courageous when facing losses, giving them room to breathe until a small scratch becomes a gaping wound. They feed their losers and starve their winners. Professionals flip this completely. They starve their losers with surgical precision and feed their winners until they grow into account-changing positions. This reversal is called pyramiding, and it's the mathematical engine that transforms small edges into substantial profits without taking reckless risks. You add to proof, not to hope. This single maxim contains the entire philosophy of professional position building. When a trade is losing, you have hope, but no proof. The market is telling you clearly that your thesis is wrong. When a trade is winning, you have concrete proof that your analysis was correct. The tape is confirming your judgment. Why would you ever put more money into a position that's currently proving you wrong, while taking money out of a position that's proving you right? That's backwards thinking that destroys accounts systematically. Think of it like betting on horse races. The amateur places his entire bet before the race starts, based purely on his analysis of the horses. He's gambling on his prediction. The professional places a small initial bet, then watches the race unfold. When his horse takes the lead at the first turn, when it's demonstrating speed and stamina, when it's proving his analysis correct, that's when he places his larger bets. He's not gambling on prediction anymore. He's pressing a demonstrated advantage. Here's exactly how this works within the $500 challenge constraints. You don't enter with your full intended position size. That would be betting everything on your initial read before the market validates your thesis. Instead, you enter with a starter position, half or even 1/3 of your maximum intended size. You're testing the waters with a position small enough that immediate failure creates minimal damage, but large enough that success creates meaningful profit to finance the next layer. Let's walk through the precise mechanics with real numbers. You identify a breakout at $20 per share. Your logical stop based on chart structure sits at $19.50, creating a 50-cent risk per share. Following your risk management rules, you want to risk $10 maximum. If you went full size, that would be 20 shares. But you're pyramiding, so you enter with only 12 shares at $20 in dollars. Your initial risk is exactly $6. The stock immediately validates your thesis. It breaks higher with expanding volume, holding cleanly above the breakout level. It climbs to $20.80, giving you $9.60 in open profit on your 12 shares. This is the critical moment where amateur and professional behavior diverge completely. The amateur sees that $9.60 profit, and his brain screams to lock it in. That's nearly 2% of my entire account. Don't be greedy. Take it before it disappears. He sells, feels momentarily smart, then watches in agony as the stock runs to $23 without him. He captured 80 cents on a $3 move because he couldn't distinguish between taking profits and cutting profits short. The professional executes a completely different sequence. First, he raises his stop loss from 1950 to 2010s, just above his break-even point after commissions. This removes all meaningful risk from the initial position. His worst-case outcome is no longer a $6 loss, it's breaking even or capturing a small profit. Second, he adds to his position. At $20.80, with his new stop at $20.10, he has a 70-cent buffer per share. Using his standard $10 risk allocation, he can add 14 more shares. Now he owns 26 shares total, with a break-even stop protecting the entire position. Here's the mathematical beauty. If the stock reverses and hits his $20.10 stop, he exits the first batch at break-even and loses approximately $9.80 on the second batch. But he had $9.60 in open profit from the first batch, so his net loss is roughly 20 cents plus commissions. He's essentially created a free roll, a large position with virtually no risk to his original capital. The stock continues to $22.50. He's now up $30 on his initial 12 shares and $23.80 on his 14-share addition, $53 total. He raises his stop to $21.50 to lock in substantial profit. If the trend continues, he might add a third smaller layer. If it reverses, he exits with more than 10% of his account captured from one well-managed opportunity. The protocol for pyramiding demands strict adherence to 4 non-negotiable rules. Break any of them, and you transform a wealth-building technique into a account-destroying gamble. Rule 1. Never add to losing trades. Not ever. Not once. No averaging down. No lowering your cost basis. No, it's cheaper now, so it's a better value. When your initial position moves against you, you exit at your predetermined stop. You don't add to failure. You don't throw good money after bad. You don't turn a manageable loss into a career-ending disaster. Rule 2. Only add after price confirms your direction, and you've moved your stop to protect capital. The market must prove you right before you increase exposure. You need confirmation, higher highs, expanding volume, breakout levels holding as support. Then you raise your stop to eliminate or dramatically reduce risk on your initial position. Only after you've protected your capital do you add shares. Rule 3. Each edition must respect your fixed dollar risk rule. If you risk $10 on your initial entry, you risk $10 on your first edition, $10 on your second edition. You're not increasing risk as you build the position. You're maintaining consistent risk management while expanding your exposure to a winning theme. This keeps your downside controlled even as your upside multiplies. Rule 4. Use open profits to finance new risk, not fresh capital. When you add shares after a move in your favor, you're using unrealized gains to justify the new risk allocation. If the trade reverses, you're giving back profit, not losing fresh money from your $500 base. This creates psychological freedom and mathematical safety. Consider 2 traders facing identical setups. Trader E enters with 15 shares at $15, stops at $14.50. The stock confirms, moving to $15.80. He raises his stop to break even and adds 12 shares. It continues to $16.60. He adds 8 final shares with a $16 stop. When the trend exhausts at $17.40 and his trailing stop exits him at $16.80, he's captured approximately $45 in profit, 9% of his account from one systematic campaign. Trader F buys the same breakout with 30 shares immediately. It fails, dropping to $14.30. Instead of taking his $21 loss, he doubles down, buying 30 more shares to lower his average. It drops to $13.80. He adds 40 more shares, desperate to get out break even. He now owns 100 shares of a failing stock. When pain forces him to exit at $13.50, he's lost over $100, more than 20% of his account on one idea executed with opposite philosophy. This illustrates the paradox of small accounts. The only safe way to grow meaningfully is not to swing for home runs from the start, but to be incredibly patient, waiting for high-quality setups, then aggressively pressing your advantage only when the market proves you right. This demands 3 rare psychological traits working in harmony: the discipline to wait for confirmation, the courage to add to positions that have already moved in your favor, and the wisdom to distinguish between strength and overextension. But here's the brutal completion of this lesson. Pyramiding is worthless if you don't know when to take profits. You can build a perfect position through systematic additions, riding a trend from $20 to $23, then give it all back by holding too long out of greed. The exit strategy separates professionals who compound wealth from amateurs who ride profits up and back down, learning nothing except disappointment. The trade is working. Your $500 account now shows $580. You've executed everything perfectly: patient waiting, disciplined entry, proper position sizing, systematic pyramiding, as the market confirmed your thesis. You're holding a beautifully constructed position in a trending stock. The tape is screaming higher with expanding volume, clean price action, and that intoxicating feeling that you've finally cracked the code. Your unrealized profit represents 16% account growth in a single well-managed campaign. And right now, in this moment of triumph, you are in more danger than you were when you started with nothing but hope and $500. Your brain chemistry has shifted completely. The paralyzing fear of loss that tortured you during drawdowns has vanished, replaced by something infinitely more seductive and dangerous: greed. Your internal dialogue transforms from "what if I lose" to "how much more can I make? What if this is the big one? What if this runs another 50% and I sell too early like an amateur?" You stop analyzing the chart and start calculating dream scenarios. You stop asking, is the trend still valid? And start asking, how rich will this make me? This psychological transition from fear to greed is where more traders lose money than at any entry point or stop-loss level. This is the graveyard of small accounts, not at the bottom of crashes, but at the peak of rallies when everything feels perfect and permanent. The professional trader understands something the amateur never learns. Exits are infinitely harder than entries. Anyone can click buy on a breakout when the chart screams opportunity, volume confirms, and the setup looks textbook perfect. Entries feel like seizing opportunity. But exits feel like loss of potential, loss of the fantasy that this might be the trade that changes everything, loss of being proven right by the market. Few can sell into strength when every instinct screams to hold for just a little more. Jesse Livermore, who made and lost multiple fortunes, distilled this lesson into brutal clarity. I made my money by sitting and waiting. I lost my money by not knowing when to get up from the table. The sitting made him rich. The failure to exit made him broke repeatedly. He understood that the market is a master of seduction, drawing you in with easy profits, convincing you that you're a genius, then reversing just when confidence peaks, and taking everything back with interest. Here's your exit protocol for the $500 challenge. 4 non-negotiable rules that will save you from the greed that systematically destroys profitable positions. Rule 1. Sell into strength, not weakness. This violates every amateur instinct, which is exactly why it works. When your stock gaps up on massive volume, when it's vertical on the chart, when chat rooms explode with excitement and everyone frantically tries to buy, that's when you sell. That's distribution disguised as momentum. The amateur sees a parabolic move and thinks rocket ship. The professional sees the same move and thinks climax. Smart money is unloading shares to greedy latecomers who are convinced they're missing the move of a lifetime. You want to be selling to the crowd, not buying from them. If you wait until the stock rolls over and breaks support, you're selling into weakness, competing with every other panic trader trying to exit. Sell when it feels wrong to sell. Sell when euphoria peaks. Rule 2. Use trailing stops religiously. You never ever let a winner turn into a loser. As your position moves favorably, your stop loss must move with it, locking in an increasing percentage of unrealized gains. You entered at $20 with a stop at $19.50. The stock moves to $22.50. You raise your stop to $21.50. It reaches $23.80. Your stop moves to $22.80. You're not guessing when to exit. You're letting the market tell you when the trend has exhausted by violating your trailing stop level. This removes the emotional torture of deciding, is this the top? In real time. You don't need to nail the top. The market will take you out when the trend bends, and you'll capture the majority of the move without the stress of perfect timing. Rule 3. Scale out in thirds across predetermined targets. You don't face the binary choice of all in or all out. That's amateur thinking for amateur minds. When the stock hits your first conservative target, sell 1/3 of your position and bank that profit. You've now paid for the entire trade and reduced psychological pressure to 0. At your second target, sell another third. You've guaranteed a winning campaign regardless of what happens next. The final third rides with a loose trailing stop, giving you exposure to an extended move while your capital is largely protected. This strategy satisfies both your need for security and your desire for windfall profits. Rule 4. Never try to catch the exact top. Tops are for heroes and zeros. The amateur who sells at $24 and watches the stock reach $26 beats himself up mercilessly. I left money on the table. I'm an idiot. The professional looks at his banked profit and moves on to the next opportunity. He knows that trying to squeeze the last 5% out of a move usually costs you the first 20% when reversal happens faster than you can react. Leave the final 10% for someone else. You want the meat of the move, not the scraps. Let me show you exactly how this plays out with 2 traders managing identical winning positions. Trader G follows the systematic exit protocol. He's pyramided into 35 shares at an average cost of $20.70. At $22.20, he sells 12 shares for $18 profit, banking his first layer. At $23.50, he sells another 12 shares for $33.60 profit, securing the bulk of his gains. His final 11 shares ride with a trailing stop at 22.80 cents. When the stock spikes to $24.10, then reverses sharply as late buyers get trapped, his trailing stop triggers at $22.80, capturing another $23.10. Total profit, $74.70, nearly 15% of his account from one disciplined campaign. Did he catch the exact top at $24.10? No. Does he care? Also no. His account is substantially larger, his process held under pressure, and his mind is completely calm. Trader H abandons discipline at the worst possible moment. At $22.20, he thinks too early, this thing is just getting started. At $23.50, he tells himself, I'll sell at $25. Then I'm definitely out. The stock touches $24.10 and he adjusts again. Okay, $24.50. I can't sell before it hits a round number. But $24.10 was the peak. A wall of institutional selling hits the tape. The stock drops to $23.20 in minutes. His brain shifts from greed to panic. It's just a pullback. I had $120 in open profit. I can't walk away with only $70. It slides to $22.40, then $21.90. He finally panic sells at $21.60, walking away with $31.50 instead of the $120 he had at the peak. He executed everything perfectly until the final 5 minutes, then gave back 75% of his profit trying to be perfect. Now we arrive at the brutal truth that reframes this entire challenge. If you followed every rule, proper position sizing, hard stops, patient waiting, disciplined pyramiding, systematic exits, but ended the 90 days with $480 instead of $580, you won. You are a complete success. You built the habits that can handle $50,000, then $500,000. You proved you can execute a professional process under real market pressure even when the result is a temporary loss. That discipline is worth infinitely more than any short-term profit. If you ended with $800 but broke every rule to get there, oversizing positions, moving stops, taking boredom trades, averaging into losers, holding winners too long out of greed, you lost catastrophically. You're a ticking time bomb. The market lent you money, but it will collect with devastating interest. You built habits that guarantee you'll blow up a larger account just as easily as you doubled this small one. You reinforced the wrong neural pathways and taught yourself that gambling works. The market loves letting gamblers win early. It hooks them for the big kill later. Your $500 was never about the money. $500 cannot change your life financially, but the process you build around $500 can change everything. This challenge was about proving to yourself that you can execute a systematic approach under psychological pressure, that you can suppress your ego when it screams to prove you're smart, that you can control your emotions when fear and greed flood your system, that you can follow rules when every instinct screams to break them. The 4 pillars of the $500 challenge stand as your foundation. Risk small, 1-2% per trade, always. Cut fast with hard stops, no exceptions. Wait patiently, because patience is a position. Pyramid into strength, adding to proof rather than hope. These aren't just trading rules. They're identity declarations that define who you are when money is on the line. If you've mastered these principles with $500, you're ready for the next level. Not because your P&L proves profitability. 90 days isn't statistically significant. You're ready because your process held under fire. The habits you've built here will compound for decades. Discipline scales infinitely. A trader who can risk 2% with $500 can risk 2% with $500,000. A trader who honors stops with small capital will honor stops with large capital. A trader who waits patiently for quality setups doesn't abandon that behavior when zeros are added to the account. The market will always be there, operating as it has for centuries. The opportunities will always come. Bull markets, bear markets, breakouts, breakdowns, trends and reversals repeat endlessly. But discipline? That's the edge you build once and leverage forever. That's the skill no market condition can take away from you. That's what separates the small percentage who survive and thrive from the majority who donate their capital and disappear. Cut losses fast. Size small. Wait for confirmation. Press your advantage when proven right. Master this with $500, and you can master it with $500,000. The principles don't change. The psychology doesn't change. Only the zeros change. If this challenge taught you discipline, if you proved you can follow a process when emotions scream otherwise, you're ready for the next lesson, reading the tape at a deeper level, identifying those pivotal points where patience must transform into aggression. Understanding the language of price and volume that reveals institutional intent. But that knowledge is only valuable for traders who've proven they can handle themselves first. You cannot read the tape if you cannot control yourself. You cannot execute with precision if your foundation isn't built on unshakable discipline. The $500 challenge was your proving ground, the mirror that showed you exactly who you are under pressure. If you looked honestly and built the required discipline, everything else becomes possible. Welcome to the profession.